In this video, I want to complete the calculations for the income statement. So we already have all of the elements that we need. We have revenues minus cost of goods sold to produce the gross margin. Then we have the other costs. Most of them we usually refer to as fixed costs. They're not a function of how much I sell necessarily. So if I sell a little bit more in the stores, so if you change the assumption of $100,000 per store in sales, if you were to sell a little bit more in those stores, the cost of goods sold would change. Those are variable. Those change with the amount that you sell in the store, but rental would not. If a given store starts selling more, the amount of rental is fixed. Similarly, the sales, general, and administrative. Similarly, depreciation. So the gross margin here will be given by the earnings before interest and taxes, rather. The earnings before interest and taxes will be given by the gross margin, that is itself revenues minus cost of goods sold, minus sales, general, and administrative, minus the amount of rental, minus the depreciation. And so the earnings before interest and taxes, as you see in your case, is $540,000 for 2018. This number will grow over time to $1.08 million by 2023. And again, this is just obtained by taking the gross margin and then taking out each of the three costs below it. The next step is to account for taxes. And taxes are 21% of the earnings before interest and taxes that we computed over here. That number is under the assumptions sheet. We have a tax rate of 21%. I will fix that number because that tax rate is true for all of the years that we have in our case, or at least right now we don't know there will be any difference, so we have to use the information that we have right now in order to compute the amount of taxes. We'll assume it is 21%, and we will multiply that by the earnings before interest and taxes in our income statement. So the tax will be $113,000 in 2018, and it will be always 21% of each year's earnings before interest and taxes. We then arrive at earnings before interest and taxes after taxes, or what people often refer to as the EBIT, the earnings before interest, but after taxes, which is just your EBIT minus the tax, or EBIT times 1 minus T. Remember that this is the main sort of key component of free cash flows from the videos that we saw last time. So you see earnings before interest and taxes minus the tax is going to give you an after-tax EBIT, or earnings before interest and after taxes, of $427,000. And you can now extend that to 2023. You now have a fully projected income statement between 2018 and 2023. And this very last line is going to be the key first element, first piece of the free cash flows that we will start computing next.